Money Online Connect virtual mining conference. I'm Niels Christensen, editor with Kiko News. I'm really excited to be here to moderate this discussion. Just before we get started, I wanted to ask. I have questions prepared, but if anybody in the audience would like to ask a question, please use the chat function in the program here. So our discussion today is how to capitalize on the gold market. I think this is fascinating. I mean, gold, if you look at gold prices, the market has been on an uptrend since mid 2019. Even a world-shattering global pandemic hasn't been enough to derail the price for very long. There's a growing consensus among market analysts that it's only a matter of time before we see all-time highs. Gold prices currently right now are near their highest level in 8 years. The mining sector is seeing record profits, extraordinary margins, improved cash flow, and that brings us to our panel discussion. And to talk about how investors can capitalize on this gold bull market, joining me today is Robert Crayfourd, portfolio manager of New City Investment Managers. Willem Middelkoop, founder, chief executive officer of the Commodity Discovery Fund. Dan Oliver, chief executive officer of Myrmikan Capital, and Peter Marrone, executive chairman of Yamana Gold. Thank you, gentlemen, for joining us today.
Happy to be here.
Good to be here.
For inviting. Yeah.
Excellent, excellent. So let's start with the question I think that's on everybody's mind. How do you develop a precious metals portfolio in this environment? You know, what looks good? The gold commodity versus the miner. Who wants to start?
Well, since as the only
Willem,
miner here, I think, may I begin?
Perfect, Peter. Thank you.
And if the question is, should you be invested in gold or should you be invested in companies that produce the metal, I would say that you should be invested in both. But while I am an advocate for gold price, and I'm sure we'll have a great discussion about why gold price is sustainable at these levels and likely will go higher, I am more an advocate for the gold equities, and in particular, this particular gold equity, Yamana Gold, which is the company that I founded and currently serve as its executive chairman. But I would say that we're in an interesting time. Gold price has gone to the levels that it has gone to, almost $1,800 an ounce. It looks as if it has legs to go substantially higher. But we're in this perfect storm that should compel investors to look at gold companies as much as gold, and perhaps more than gold, as a metal, as an investment class. And I'd say that there are two reasons why investors should be looking at gold companies more than the metal itself. The first is the multiplier effect. With a higher gold price and likely increasing gold price, we have the classical situation of companies that are producing a certain amount of metal today, that may be producing more tomorrow, that are generating a certain amount of cash flow and free cash flow today, that with improved margins will be increasing that cash flow and free cash flow, more resources in the ground. So across all of the measures, cash flow, net asset value, free cash flow, it is likely that will increase. Certainly we see that in our company. And so it's not just the increase in the price of gold per ounce, but it's the multiplier effect of that increase times the extra number of ounces that one would be expected to produce, particularly if one has growth in the company. I'd say that there's a second reason for investing in it, and that is that valuations are not supporting what the gold price is. Now, one way to look at that is to say that the market is suggesting that the gold price is expected to decline. I don't see that as a realistic possibility. And so the higher probability is that gold equities are today trading at exceptionally good valuations. If we look at where the gold price was in 2011, 2012, and the valuation of gold stocks at the time, I'd say that there's a significant amount of upside in the gold equities, more upside in the gold equities in many respects than there is to gold price because of that valuation issue. And the final, I would say, is yield. And it's important to refer to yield, not just to say in its absolute terms that gold equities mostly all of the gold mining companies pay a dividend, and so they're generating yield for investors, and gold does not. But there's a more, or perhaps fundamental point, and that is that yield, that dividend, is in many respects compensatory. If you invest in gold, you have the risk of gold price, but not operational risk. If you're invested in gold equities, then there is operational risk that there isn't in investing in gold. And I'd say that for gold mining companies to be relevant and to demonstrate to investors that it is a better asset class in many respects than gold, although gold is a great asset class, I would say that we have to demonstrate that we can pay dividends and continue to increase the level of dividends. That's that compensatory factor, along with delivering good cash returns to investors. It also acts in some measure as compensation for the possibility, at least, the risk of operational issues that does not exist in investing in gold. I'd say those things combined make for a very interesting proposition for investing in the gold equities today.
Okay, so what do you guys think about that? Anybody else? Who else wants to chime in here? Willem.
Yeah, please. I agree on the valuations point, but there's not one gold equity or one gold company. There's several. And if you look at the royalty and streamers, which we liked a lot, especially during the crash in March. But the valuations of the royalties and streamers, is quite rich. And if you look at the valuation of the senior producers, that's quite okay. But if you look at the junior producers, they're still very, very cheap. And if you go down to the non-cash flow exploration companies, there's some real bargains still to be found. So in our portfolio, we have them all. So we have 5% in the royalties and the streamers. We have around 15-20% in the intermediate and the smaller producers, and then we have 40% in exploration phase. So, and I think it's quite important as a professional or as an investor to understand the different parts of the cycle, because in the different parts of the cycle you should invest differently. So it's good to start with the majors and the royalty and streamers, and now the recovery is ongoing for a few months, and gold price expected to rise further. It's better to go a little bit more down to the smaller companies.
Yeah, I would agree with that comment. I mean, I'm fortunate that my fund's closed-ended, so that gives me a bit more flexibility with liquidity. But I generally have a junior bias. I mean, one of the main themes through my portfolio is that we're more invested in either sort of developers or kind of earlier stage producers, and the relative performance versus the GDXJ has been material. In the last quarter alone, my fund's outperformed the GDXJ by 40%, and we're starting to see a big capital rotation now out of those larger cap producers that are at 1.2, 1.3 times PNAV, which historically isn't even that expensive. They have the insurance policy aspect of precious metal stocks, but these juniors are trading at 0.5, 0.6 times, sometimes 2 times EBITDA and a 30% free cash flow yield. I mean, the whole sector, Peter's completely right. As a whole, the sector looks optically, very attractively valued versus the overall market on almost every basis. But these juniors look even more appealing, and we're starting to see capital flow that way. And I think it's coming, primarily coming from retail. We've seen a big shift over the last 10 years of ETFs requiring greater liquidity. A lot of the major gold funds have increased their liquidity requirement, and it's kind of left this sort of stranded asset base, which have all traded at an effective discount, and it's really left an opportunity there. And I think we're very much at the early stages of that.
If I can expand on the
I think Dan might be having some internet problems. Dan, can you hear us? Okay. Dan,
may I volunteer a further comment? And I don't mean to throw the panel off on some different point, but the observation that was made, I think, is an excellent observation, that it is the time in the cycle. And while we've discussed the time in the cycle for investing in producing companies, possibly even going to some of the smaller producers, the intermediate-sized companies, and the valuation gap that exists. I'd say that there's a significant valuation gap between the royalty companies and the producing companies, and that's something that can't be overlooked. One of the questions that we're often asked by generalist investors, and we're seeing more generalist investors wanting to know what the sector is about, what our company is about, one of the things that becomes very evident is that we seem to be at a point in the cycle now where investing in a producing company is more relevant to an investor and presents a better value proposition than investing in royalty companies. That isn't to say one shouldn't invest in royalty companies, but when we go into a point in the cycle where gold price is going higher, then inherently there is more of the value, more margin, more cash flow that is on the side of the ledger to the producer versus the royalty companies. And indeed, I would go further and I would say that the type of deals that can be done by royalty companies become increasingly difficult to do. There are other options available to companies rather than just going with a streaming deal or a royalty deal. And I suggest that means that investing in a gold producing company today is a far better investment for the next several years than investing in the royalty company.
Well, and I think this brings up an interesting topic. I mean, sort of everybody has, like there's so many choices for investing in the gold market today. So I guess, the question, the next question on my mind is, what percentage? I mean, if there's so many choices, I mean, how would you break up that portfolio? Like what percentage would you put to producers? What percentage would you put to juniors? What, royalties, and even the raw commodity? Do you guys have a makeup in mind? Is there any sort of magic number that you look at, when you're making a portfolio? Dan, maybe you'd like to chime in on this? I hope your internet is.
Well, let me see if I can get some points in before my internet cuts out again. But I wanted to make a distinction between a credit inflation and a monetary debasement. And one of the problems investors have is from 2000 to 2008, gold ran a lot nominally. The problem is the cost kept going up more. Right. And that's because it was a credit inflation. The Fed was putting money in the banks were lending it out and commodities went up more. So investors are trained that, okay, gold goes up. It may not help the gold miners much because you get margin compression. Now, their debt melted away, which is why the senior equities did well, but the junior guys got crushed because there was no margin in their projects. This is very different. The HQEs are funding current expenditures. And so it's not a Keynesian sugar high credit inflation. It is monetary debasement out of the 70s, which means that gold is going to go up nominally a lot. Commodities may go up nominally too, but not as much as gold, which means for the first time in really since the 70s, you're going to have margin expansion. And that obviously will help the senior producers, of course, because their margins expand. But what really helps is the junior guys, that all of a sudden their projects will have there's a margin, they're not operational, but the net present value will keep expanding.
Sorry, I apologize. It looks like Dan's still having issues with his internet. Does anybody want to see, how would you make up a portfolio? Like what percentage should investors be looking at? Does somebody want to take that, Willem?
Well, as I remarked in my previous comments, in our portfolio, and what I sometimes advise investors when they ask for my opinion, first start with some physical. That's the insurance of your assets. And actually, if you buy physical, it's another form of cash allocation. So instead of cash, you add some physical. Mm-hmm. So on average, people say, like the Swiss bank has 10%. I prefer 25%. Given all the risk out there, 25% physical. But now I talk for high net worth individuals, and then if you add some royalty or major producers, let's say 20%. And then you can add some juniors, but that's more speculative, and you don't do that with more than 10 or 20% of your funds.
Mm-hmm. So we do have a couple questions from the audience. I wanted to introduce one. I think it's always interesting. It's always sort of topic, and that's peak gold. What do you guys think of this idea of peak gold? Is it a reality? Is it something that just isn't important to the
Neil,
sector?
I think I think the answer is no. I mean, if you look at cutoff grades, right? 100 years ago, standard cutoff grade was an ounce per ton, more or less. You didn't mine stuff less than that. In the 1930s, it was a half an ounce per ton. Really, you just left stuff behind. Today, open pits, half a gram per ton. Underground, you see 2-3 grams a ton. And as technology improves, and more importantly, if you look at a 300-year chart of commodities against gold, commodities have been falling against gold for 300 years. What that means is, again, margin see continual expansion over hundreds of years. And so we're going to see going forward in the future falling cutoff grades. And all of a sudden, mines that have been totally mined out become productive again because the waste turns back into ore. So, I mean, there's unlimited amounts of gold available. And of course, there's going to asteroids in the ocean, all those places. And as cutoff grades come down, then mines become more productive.
Peter, what are your thoughts as a producer?
Yeah, so it's an interesting question. I don't know that I fully understand peak gold and what it means, but what I do understand, I'm not sure that I can come to a conclusion that's different from what's been said. I think that technology, changes to cutoff grades, new interpretations. An example of that is our Canadian Malartic mine. Who would have assumed that 1 gram per ton makes for a very, very elegant and very profitable operation in northern Quebec and northern Canada, let's say a decade ago. But it's the largest producing gold mine in Canada at more than 650,000 ounces per year, and very profitable at just over a gram per ton. So yeah, I think that that's entirely correct. But one thing that you asked the question, is it relevant? I'm not sure that it is relevant. I think that what's relevant is investor demand, what's happening in the broader market, what's happening in the derivatives market, in the contracts market. That's far more relevant than the number of ounces that are produced. But at the margin, the number of ounces that are produced can make a difference. And it does seem to me that certainly amongst the larger producers, we produce just over 1 million ounces per year. But to be producing 5 million, 6 million, 7 million ounces per year, it seems to me that that's one heck of a challenge, not for the production, but for the replacement of those ounces. And so it does seem to me that there is going to be a decrease in the number of ounces that globally is produced in the marketplace. So to the extent that at the margin it can make a difference, that in other words, we've reached a point where the total amount of production in the world has hit a peak and is in decline, I think that is something that should be looked at, could be a risk. There are going to be new discoveries, like a Canadian Malartic, that replaces that 600,000, 700,000 ounces per year. But when you're producing 5 million ounces per year, 4 million ounces per year, or more than that, replacing that year over year becomes increasingly difficult. And losing 1 million or 2 million ounces in that size of an operation completely swabs and overwhelms the growth that comes from other companies that have made some of these discoveries. So I think there's some relevance to it, although it's untested yet whether or not that will make a difference in terms of the gold price.
I wanted to ask this. So, Peter, you and Robert actually brought up valuations. They're improving, but they're still really low. And Robert, I guess, give you a chance to speak. I wanted to ask, what do you think it's going to take to get investors back into the market sort of en masse, to get valuations where they're fair value, I guess? What do you think is needed?
Yeah, well, I mean, I guess initially a lot of investors were burnt in the last bull cycle. A lot of companies made acquisitions at the wrong time, hedged poorly, and ultimately sort of destroyed capital on that basis. I think what we're seeing now is far greater level of discipline. I think what we've lost is kind of a lot of the overall investor base. I mean, if you look, materials is only sort of 4% of MSCI World or something now, and of that, precious metals is only about 10%. So it's kind of a sector that's been easily ignored by the generalist investor. What we've seen more recently is we have seen some sort of more generalist type flows starting to come back in, but actually a lot of it's quite retail. And actually, I just saw a note yesterday saying that the Robinhood investors had picked up on one of the gold ETFs in the US, the 2 times levered. So as we've seen, they managed to almost pull Hertz out of bankruptcy. So if we start to see some retail coming out of the US like that, we may see some material interest.
A two times ETF. That's even in a bull market. That's still a little risky. Well, does anybody else have any comments about, sort of what's going to bring investors back to the marketplace? Does anybody else want to take this question?
Well, I can give some
Willem.
evidence. I can give some evidence what we've experienced in our fund, and we've seen huge change in interest among the high net worth, the retail audience, and that already started, I think, 14 months ago. That more investors were knocking on our door, and we've seen a huge inflow of capital. We're a small fund still. We're just over 100 million Canadian. But we doubled in size in the last 6 months, and this was partially because of the inflow of capital, and especially since the crash in March, that really changed the sentiment among retail investors. And many people, it used to be us gold bugs warning about the monetary madness out there, and this is now becoming mainstream. People really got a wake-up call that something is really wrong out there. And I think it's quite mainstream now to understand you have to look for security and to hedge the risks, the financial risk, to add hard assets and especially precious metals to your portfolio.
And I would say, Niels, that it seems to me that we need generalist investors to make that difference. And generalist investors will jump into gold price and gold equities when gold price demonstrates resilience, that it's sustainable at these levels and doesn't have to go higher, but certainly that it's resilient. And the companies in the sector show that they can generate margins, improvements to margins, and free cash flow growth as a result of those prices. And that captures a comment that was made a few moments ago about the mistakes in the last cycle. And there were mistakes made, but I don't know that we can lay it, perhaps as an advocate for the industry, I don't know that I can say that we can lay those mistakes only at the feet of gold mining companies. I think that there was an agreed value proposition between investors and companies as to what was relevant. And investors were looking for growth, and companies were providing that growth. And today it seems to me that companies are saying financial performance counts more than it ever has and must count for more than it ever has. Hopefully we'll maintain that vigilance, and investors will see that as a proper way to measure a company. That when generalists come in, when resource funds continue to improve their portfolios, and I think at that point, that value proposition of stick to the knitting of financial performance, I think that's what will bring increasingly more and more investors in.
Okay. I got another question from the audience here. Dan, maybe you want to jump in on this.
Okay.
Trump versus Biden. We are looking at anybody can take this, but I just wanted to give Dan a chance because he's been having internet issues. But what do you think is better for gold? I mean, it does seem like markets aren't really. Some of the stuff I've read is markets aren't really pricing in a Biden victory. Is it really too early in the election cycle to sort of be looking at this? I mean, what do you think?
Apparently, the broad money supply growth is 25% up in the last year. That is just a tremendous amount. I mean, we haven't seen anything like that since the 70s, and that's what's driving the institutional interest in gold and general investors panicking into gold. And of course, it's also going to drive, as I mentioned before, margin expansion. In terms of Trump, Biden, I mean, I don't think it matters in the sense that Trump has shown, and Republicans, when they're in power, can't spend money fast enough. I mean, stimulus after stimulus. So I really, Trump just doesn't get the deficit at all. Biden will be worse. I mean, I think if Biden wins, the U.S. will beat Argentina in about 18 months. They'll take the Senate. They'll pack the courts. We'll have all these social programs. It'll really be, through our country. So, which is worse? I think it's just a question of how fast the U.S. gets to Argentina, and we're heading there in pretty quick direction.
Does anybody else want to handle this political hot potato?
Well, I think the answer should be it doesn't matter, because whomever is in power, it seems to me that the fiscal stimulus that's been provided in the United States and worldwide, the amount of monetary stimulus and the printing presses on money, and it's interesting. You mentioned the United States. There are other countries, of course, where the issue is relevant, and gold is at all-time highs in some of these other currencies, which is something that we can't overlook. But in the United States, it seems to me that there's an adrenaline that's been pumped into the system because of the stimuli that have been put in place, the amount of money that's been made available to individuals, unemployment insurance benefits, that is due to expire within the next month. There has been a deferral of amounts that are to be paid on things like rent. That is due to expire within the next month. So either there's more stimulus, which means that the printing presses continue to print again, or there's this cliff that's in front of us. So it seems to me that whomever is the president or whomever leads any nation, there's this daunting task in front of them of how to fix all of this. And that fix is not going to come immediately. It will take several years. It's terrible comparisons, but we're in depression era type fixes and duration. And so it seems to me that it doesn't matter who's there. It's going to continue to be good for gold price and for the companies that produce the metal.
And now we're running out of time here. I wanted to direct this to the three investment guys specifically. What, when you're looking at a mining company to invest in, what do you want to see? Do you want to see them put money into the ground and build their pipeline, or do you want to see them reward shareholders? Where is the value do you see? Who wants to? Willem, you can take that first.
Yeah. I want to see lower salaries for the board. No, I'm serious. I'm that serious. We as fund managers have a salary of 100,000 euros a year, or even less.
Mm-hmm.
And then I'm having conference calls with boards asking us to invest some more money. And then when I look at their salaries, it's a few million a year. It's utter madness, and that is the reason why we shy away from the major companies.
Do you think it's going to get worse? I mean, with gold prices going up, do you think that the compensation
it has been going worse every year in the last 10, 20 years. There's a system, especially we've seen that in the city, we've seen that in the US. There's a system in which the boards always can point to a research or report or to an industry level of compensation that is justified, but you can't justify this in any way.
Yeah, Niels, if I can jump in here, it's not just a salary. They get big salaries. They also get big option packages. And if you think about the option in terms of Black-Scholes valuation, the easiest way to boost the current value of your options is to increase the volatility of your share price. And the way you do that is you take a bunch of debt on and buy a big project. And that's why executives are incentivized to do crazy things at the top of the cycle. The bankers are the same incentives. They throw money at the top of the cycle. They overspend, and then gold goes down. And then, of course, they're in world trouble because their cash flow sinks. They go, it's debt. It's in every industry this happens, but it happens especially in the gold industry because it's so easy to lever up your balance sheet and buy a new project. So until investors call halt to that, they'll keep doing it. And that's one reason why the juniors are so much better, because generally the juniors are full of entrepreneurs. I mean, if you get rid of the crooks and the shady ones, you've got entrepreneurs who own a big piece of the company themselves and really care to take small salaries. That's where the value creation is going to be.
Mm-hmm.
I agree with all of those points, and they're major drivers of our investment decision as well. Do we have time?
Yeah. We have 1 minute remaining.
On the build or like spend versus return of capital, I think we've got a real bifurcation in the market. So I think what we're seeing with the larger cap producers is they're under quite strict instructions from their investor base, which is typically more or primarily, as far as they're focused, institutionally led, and they're being told to focus on continued improvement of balance sheets, potential dividends. They're not allowed to go and make acquisitions at premiums. But then that's led in a scenario where in the last decade, and this is back to Peter's point, new discoveries have only constituted 20% of the global produced gold in the last 10 years. So the rest of what we're seeing is just recycled gold projects. Now, at some point, these larger companies either have to just go completely ex-growth and just return cash, and then we get a new sort of subsector below that can offer growth and other aspects. But it's a real bifurcation, and it's not clear how this is going to resolve itself. Whether investors are going to change their view and larger cap should return to just replacing reserves, never mind growth. I mean, there's a real pinch point coming up, and I think we're going to see how this looks.
Well, thank you very much. We actually have to end it there. Our time is up. I just wanted to thank you very much for this discussion. It's been fascinating. I love the information that you guys have provided. Again, thank you very much for your time.
Thank you.
Thank you.
Thanks for having us.
And everybody in the gallery, thank you very much for watching this panel discussion at Minds and Money Online Connect.